我觉得你看的光有弹幕，说的那个弹幕所有东西，还是要重新又一遍。I was trying to 他不燃了。
Ladies and gentlemen, let's make a start. So today we are starting to get into the substance of the risks we're covering. And we're starting with credit risk. Now, as we said, credit risk is the biggest of the risks in terms of capital. Interestingly, as I mentioned, the remediation for Big Four banks from conduct risk is now up to 10 billion. And I don't think that the credit losses for the big banks are anywhere near that. But from a capital perspective, the amount of capital that banks hold for credit risk dwarfs the amount of capital that they hold for conduct or compliance risks, which is only a subset of overall operational risk. I mean, we're talking about, credit risk modeling showing more than 10 times capital being held for these types of risks. So, for us today, we want to look at a little bit about what is credit risk, where it comes from, what structures are in place to manage and mitigate credit risk, and then a little bit on the models, so standard model, internal model, and then we'll see the major issue from credit risk is trying to finally understand what is the probability of default. And then lastly, I just wanted to cover a little bit on credit risk in trading operations. So when we look at our balance sheet, as always, we talk about, we've got our assets, liabilities plus equity. So as we know, here on the liabilities and equity side, we've got our standards, deposits, CDs, bank bills, bonds, and equity. And then on the asset side, this is where we've got cash, different types of loans, so credit card, personal, home, commercial, then say we've got some real estate, and some other assets. So when we look at, and then we'll go to trading portfolio, the trading book. So when we have our balance sheet, we talked about where do we find credit risk. Where are we going to find our elusive credit risk? All right, we're going to find out credit risk on the left side, and generally speaking, we're looking at the banking, right? So anything that's not the trading. So most of the models, right, the vast majority of the models will look at this, right? And then during GFC, people realized that we actually face quite a significant credit risk in the trading book as well. And that last part, which I call the CVA, credit valuation adjustment, we'll look at CVA as well. So CVA is looking at credit risk in the trading book. Right. So that's the plan. That's the plan for today. Now, I think I've got most of you here. Just to let you know, next few weeks we'll have to move some of the lectures around because I'm overseas. I'm in Japan next week meeting with regulators, and then the week after I'm in Hong Kong meeting with regulators. So those, I'll figure out which classes I can make, which I can't, but we will have a class, but it just might be on a different day. And it will be recorded as always, so bear with me. All right, so as always, we've got the sources. So, starting with credit risk. As I said, looking at the Basel framework, from a Basel framework perspective, that's kind of where we're looking, right? We looked at capital last time. Now we want to understand a little bit about the nature of credit risk, and then a little bit about the standardized and the internal ratings-based approaches. Ultimately, we look at our prudential capital ratio, minimum capital ratio, COOP ratio, whatever we want to call it. Right, so prudential capital ratio, and that equals to amount of capital divided by risk-weighted assets. And from a risk-weighted assets perspective, we said that the biggest one is going to be credit risk. Right? So how do we calculate risk-weighted assets for credit risk? So what is credit risk? Credit risk is probably the easiest to understand. It's the first risk that was described in the Basel framework, as we looked at last week as well. Right? That's what the framework was about. Right? But what is it? Well, it can be defined as the potential, right? Because we're talking about the risk. If you know that something has happened, if somebody is already defaulted on their obligation, if somebody owes you money and said that they're not going to pay, that's not so much a risk, that's a loss. So the risk is the potential that a borrower or a counterpart, so a borrower is someone you lend money to, a counterpart is somebody you do a transaction with. So a borrower or a counterparty will fail to meet its obligations in accordance with the agreed terms. Now, when we talk about agreed terms, we're talking about, ultimately there's two elements, right? The two biggest elements. One is the size of the payment, and the other one is the timing of the payment. Right? So, saying, yes, I will pay you, just not today, but in a week's time. Right? Now, to you, a week may not be all that long, but if you're talking about borrowing, say, 300 million during GFC, a week is a lifetime. Right? So we're talking about agreed terms, the timing and the size. To put it in perspective, in trading environment, when you're trading and you have a margin call, that's where the exchange or the broker tells you that you need to deposit additional securities. At different times, you have different time frames to comply. Your time frames could be as short as 1 hour. And then if you haven't responded to your obligations in 1 hour, your positions can be shunted, can be closed down. Right? So, in terms of the point, so if that's credit risk, then what is credit risk management? The idea of credit risk management is not to minimize the amount of credit risk. Because if you wanted to minimize the amount of credit risk, you just shut down the firm. Ultimately, the point of a bank is to take credit risk. The point of a bank is to lend money out. The point of a trading firm is to trade with someone. So you will always have some sort of credit exposure. So you're not trying to minimize the risk, you're trying to optimize the risk. And that means trying to maximize your risk-adjusted returns, but from a pure risk management perspective, you need to understand the risk, and then you need to mitigate and manage that risk. Right? So you want to get the best return you can. If you are going to take the risk, you want to take the best possible return, risk-adjusted return, for taking on that risk. So examples of credit losses: failure to repay, failure to make a payment on the derivative contract, or if you take a security and then the issuer of the security gets downgraded. Right? So you also have some exposure through that. All right. Why do we measure credit risk? So there's kind of three really big reasons why we measure credit risk. So the first one is supporting origination. Does anyone know what the term origination actually means? I love it. It's a very common term in investment banking language. So often people talk about, I work in origination. I work in the investment banking origination. What is it?
Is that deal origination, the start of the deal?
Okay, so origination is the establishment, correct, of a new facility, right? So we're talking about support origination is if I want to lend money to someone, right, that's a new loan. If I'm going to lend money to you, that's a new loan, right? And for that, I need to understand what is the credit risk. You can't just lend money out to anyone. You need to really analyze credit risk. So, two elements. One is, given the risk and a fixed price, is the asset worth taking? And the other one is, given the risk, at what price does the asset make sense? Now, it's essentially the same problem, but just cast from two different perspectives. And the way you can look at it is this. And we'll address this distinction a little bit more today. So think of it as a difference between retail and institutional products. When you get a credit card, like if you wanted to apply for a credit card is a loan. So if I go to ANZ website, so if I look at, say, their website, and I go, say, ANZ credit cards. Right? So I can, anyone can apply to ANZ credit cards. Right? So we can have a look, and we can look at what different cards are available, right? And we can figure out what rates, right? So you can see what are the different rates of interest on each one of the cards. So essentially, you pick a card, whatever credit card, ANZ Rewards Travel Adventure. No? Okay. So if we pick that card, the interest rate is 20.24%. So in a sense, the price of credit is fixed. It's 20.24%. So, and anyone can apply. So all of you can apply. And now, this is the question for ANZ. They have to figure out, given this price, who is a good risk and who is not a good risk. What customers will satisfy their requirements to provide good risk-adjusted returns, and what customers won't satisfy the requirements. So they are not going to say, okay, you are low risk, so we'll give you 20.24. Now for you, we think that you're a good customer, but you're a bit more risky, so we'll offer you the same card, but we'll charge you 22%. Right? They're not going to do it for credit cards. Why?
It's hard to identify the risks of other people, and it's will spend a lot of money.
Okay, so one element is trying to really identify the risk of each individual. Fair point, but I'll come to that. What's the other issue?
Default risk is low.
Default risk in credit cards,
Yeah, it's low.
very high. Very high. Highest of all the different lending, credit card, and fraud in credit card, quite high. Just FYI, and quite a few firms can't make money on credit cards because of the default risk. There's a standard scam where people come, get a credit card, and then move overseas after spending all the money on credit card. So, what's the other issue? And the other issue is an issue which is not a theoretical issue. It's a very practical issue. How many people have an ANZ credit card, roughly speaking? Let's say 1 million. Now imagine if they had to separately set up 1 million assessments and have a different rate for 1 million customers. And each customer is broadly the same but a little bit different. So, 20.24, 20.23, 22, 21, 27, right? From an operational perspective, it is an absolute nightmare. It's just operationally, it's not sustainable. So when we have retail customers, you can't give different price to different customers. You can have some broad categories, premium, one rate, average, like platinum, gold, silver, bronze, and you can have sort of different rates there. But you might have 4 categories. You're not going to have 1,000 categories. As soon as you start to have more operational complexity, you will start having errors, breaches, and you will lose money. Now, to come back to your point about analyzing the risk of each customer and the visibility. That is actually exactly the task they have to undertake. Because if they don't analyze this task, if they don't analyze the risk, they'll end up lending money to the wrong people. So they have to analyze the risk, which they do. So whenever you apply, and they also have to do it by law, and we'll come to what exact assessment they have to do. So they have to analyze each person and essentially come up with a credit score for each person. But operationally, they can't give them different pricing. The second point is, given the risk, what price is required to make the asset worth taking? Now, this is the reverse of that question, and that one applies more in the wholesale markets. If I'm going to lend money to BHP, I know what's the risk of BHP. The question is, what is the rate that I can lend money to BHP? Right? So, given the risk level, at what rate will this loan make sense for me? I know I can lend the money and I can win the loan by offering a low rate, but at some stage the rate is so low that it's no longer a good loan for me to make. The second point of credit risk measurement is to support portfolio optimization. So the first point was origination, making of a loan. The second point is portfolio optimization. After we made the loan, what's next? So after we make the loan, we need to optimize. So can we improve our portfolio's risk-return characteristics? And this is where, I like in this course to bring different ideas that we have covered before all together. So you guys have come across Markovitz's portfolio theory. Right? What's that theory all about? What's the point of the Markovitz portfolio theory?
ratio.
Okay, but ultimately, what are we talking about? What's the underlying idea?
Are you looking higher return with less risk?
Right, so that's what I'm trying to optimize. But what makes market theory work? Like, what's the driving force?
Diversification.
Diversification, correct. Right. So we've got all these individual stocks. And we are saying that if we invest into individual stocks, we can get this sort of risk-return payoff. But if we actually have a diversified portfolio, then we can end up with this, and then we can draw our capital markets line, right? And we can get a portfolio somewhere there. That's the idea. We use diversification to get a better outcome. The same concept applies to credit risk and to portfolio optimization for loans. Because you make the loans, you make decisions at a point, like in the branches, in the business, you're making decisions to lend based on the criteria that you have. But after you make all of these loans, you have a portfolio. Portfolio optimization is then assessing what is it that I have, and then saying, is there a way to improve this? And you might say, well, actually, I ended up more concentrated. My lenders in Sydney worked harder than my lenders in Melbourne, so I ended up with too many loans in Sydney. So therefore, I'm overly exposed to overweight in my loans in Sydney. Or I think that I have some fears about where the market might be going in terms of the apartments, so I'm overweight in the apartments. Right? Or I have too much exposure to the property, to the commercial property sector. So that's knowing where the credit risk is, you can optimize your portfolio. And how do you do that is you can sell some of the loans, you can securitize some, or you can hedge some of your risk through credit derivatives. And the other element is actual capital management. So from a capital management perspective, is actually looking at, given our portfolio, our optimized portfolio, how much capital do we need to set aside? How much provisions do we need to set aside, right? And do we have sufficient capital for right now and for what we want to do going forward as well? So that's the three aims. In terms of the structures, you often hear references to structure. Structure is just some sort of a contract, some sort of an arrangement under which you have your credit exposure. The most common structure is a loan, but it can be a lease, a finance lease, an operating lease, a hire purchase agreement. So if we look at retail customers, the personal loans, credit cards, car loans, leases, and hire purchase agreements. Right? So hire purchase agreement is, say, if you ever see an ad for like radio rentals, right? So you hire a TV, and then at the end of it, you get to buy it. Now, if you guys work in study finance, work in finance, if you ever do a calculation or something like that, you find out that you end up paying about 4 times the price you can get out to buy that sort of piece. But that's some people go for. Home loans and home equity line of credit. Does anyone know what a home equity line of credit is? So home equity line of credit, so let's say if you've got a house worth $1 million, right? So how much would the bank be prepared to lend normally? What's the normal loan to value ratio? 80%, correct. So the bank normally would lend $800K. Right? So if you borrow 800K from the beginning, that's a home loan. A home equity line of credit is, imagine you actually only need 200K, but the bank is prepared to lend you up to 800K. So a home equity line of credit is where the bank says, all right, well, we'll actually allow you to borrow up to 800K. So this amount you can just borrow for your own purposes. It's not to purchase a house. You can buy it to go on a holiday, to buy a car, whatever you need. Right? So you're using the equity in your home for other purposes. So that's your home equity line of credit. In terms of large companies, you've got commercial loans, commercial lines. What's the difference between a loan and a line of credit?
Loan is the money you borrow. The line is the money you can borrow.
Absolutely right. Loan is what you have borrowed or agreed to borrow. Line of credit is just like that home equity is line. It's saying you can borrow up to this amount. And for commercial lines, the bank actually charges you even if you don't use it. So there is a fee if you have a line, even if you're not using it. Letters of credit and various guarantees. So that's often used in trade finance, right, where the client says, look, I'm purchasing some equipment and my seller wants a guarantee from a bank. Leases, so especially equipment leases, mining equipment, planes. Qantas generally does not own any of the planes. Right? Generally speaking, those planes are leased by Qantas and financed by one of the major banks, same with Virgin. That's a very typical model. And you've got credit derivatives as well. And in terms of trading, if you own bonds, you've got credit risk, or you face some credit risk. If you've got asset-backed securities, you face the credit risk of the underlying assets. If you borrow and lend securities, if you trade on margin, and also if you have credit derivatives. So, when we look at this retail versus institutional, when we look at the retail versus institutional, for retail customers, we cannot have a process that is too specific to each person. You must have a very standardized process. So that standardized process, whenever you apply for a loan, a credit card, if all of you went to apply for an ANZ credit card, you will all face the same application form. They're not going to give you a different application form. It will be the same application form. It has to be a standardized process. And in that standardized process, they'll ask standardized questions. And those questions will be used to assess your credit risk. And they will be, things like type of employment, length of employment, marital status, number of dependent kids, how long you've been at your address, how many credit cards have you got, how many loans have you got, what's your amount outstanding, bank balances, number of defaults, number of previous requests for credit, all kinds of things. Now, generally speaking, all of those answers will end up giving you some sort of a internal score, internal credit rating or score. And then that number will be compared with whatever the cutoff is for this product. And that's where the risk-return trade-off comes in. For the bank, they've analyzed and they said, we are only prepared to accept customers for this product that score this much. Different banks can have a slightly different algorithm and can give you slightly different results. So they can assess casual employment differently. They can assess the time it takes, the time you've been employed in a particular job differently. But ultimately, each bank comes up with a quantitative score for you. In US, it was known as the FICO score. They have a very well-defined model that everybody uses, right? And that's the score, and people know what their score is. In Australia, we now have a credit scoring system as well. You can actually request your credit score as well for free if you're prepared to wait for like a month. Or you can pay like $50 and get it immediately, or you can just request it. And that will tell you what your credit score is based on all the data that they collect. Now, that's what the current process. What about the legal requirements? Interestingly, in terms of financial system, lending historically has not been defined as a financial product. So in terms of financial products and licensing, so if we go back to week 1, I said each financial services firm in Australia has to be licensed. But the definition of that requirement and the license itself, Australian Financial Services License, it did not cover lending. Covered securities, bonds, FX, payment methods, right? Custody and clearing services, but not loans. Loans only became defined as a credit financial product in about 2010, and that's when a new type of license came in, an Australian credit license. So most banks have 2 licenses. They have an Australian Financial Services license that allows them to do all other things, trade in financial instruments, provide depository services, provide custody and clearing, provide FX. And then they also have an Australian credit license to allow them to provide credit to individuals. So that's a relatively new requirement. We did not have it before. And banks or anyone that holds an Australian credit license is subject to the National Consumer Credit Protection Act. And under the Act, a lender must make reasonable inquiries and take reasonable steps to verify the information. Okay. So first of all, it's just like KYC requirements. There's 2 elements. One is asking the questions, and number 2 is taking reasonable steps to verify that information. So obtain answers and then try and verify that those answers are actually correct. Right. So this is where you'll be asked to complete the application form, and then you'll be asked for evidence to document that your answers are actually correct. And then you must make an assessment as to whether the loan is unsuitable. So that's quite an interesting requirement. And I'd say there's a number of reasons why GFC was such a big issue in the US and wasn't an issue in Australia. GFC itself. And ultimately, we can talk about a number of things in the US, but it all started, the first step in the process is the fact that US financial institutions were making really bad loans. Right? So they were making very poor credit decisions. They were lending money to people that were not going to pay them back. Or the chances of them paying it back relied on continuously increasing residential home market. That was the only circumstance under which those loans were going to be paid back. So those decisions were being made, and those decisions were bad. It was a poor credit decision. And the problem was that those poor loans were then being repackaged along the way. And the losses did not really hit the person who was making the loan. But in Australia, banks tend to hold on to the loans they make. We have securitization, but it's not that significant. But the issue is that whoever made the loan has to assess whether or not the loan was unsuitable. And if you make a loan that is unsuitable, it's not the problem of the borrower, and it's not the problem of somebody that buys the loan. That problem is still your problem. So if ANZ makes a bad loan, so if I'm ANZ, I make a bad loan, and then I sell that loan to you, right? And then the borrower defaults and makes an accusation that I made an unsuitable loan, I made the loan. So I face the responsibility to ask. And that's why in Australia, generally speaking, banks don't really make bad loans. And the credit losses on lending are not that high, especially on home lending. Credit cards are trickier because there's quite a bit of fraud involved, and it's hard to understand. So it's not so much about making unsuitable decisions, it's rather more you make a decision and then you're subject to fraud. That's where a lot of losses come from. So when you are assessing, what's unsuitable, unsuitable has an element is whether the loan meets the objectives of the person and whether the consumer has the capacity to repay. So if I'm making a loan to you, I need to make sure that the loan is what you're looking for, satisfies your needs, and you have the ability to make repayments. And before the law came in, the common law, Australia, as I mentioned, is a common law country. So we have a combination. So in, say, in Europe, Europe is a statutory law country. Most countries around in our region are also governed by statutory law. So for example, China, for example, Japan. If you want to know what the law is, you look at the statute, you read it, that tells you what the obligations are. Australia, Canada, UK, South Africa are common law countries. So we have some statutes, and we also have some law that developed through cases over time. And through these cases, we have had a concept of unconscionable conduct. And this means that if the bank engages in unconscionable conduct, then the borrower could be found not responsible for the loan. And we've had a number of cases on this where somehow the bank ends up lending money to the person, but there's no way to make repayments. Right? So for example, they're making, there was a case about a young person got into a car accident, became disabled, is on a disability pension, wants to buy a small flat with the money that they got. Instead, the bank said, no, why don't we'll lend you some more money and you can buy a bigger house, and then they get the loan and then they default. And if you look at it, their pension is not enough to make the repayments. There's no other way they can earn money. So then the bank is engaged in unconscionable conduct. The bank is responsible for the loan, right? So we've had that before, but now it's in the statute as well. So as a bank, you have to consider a number of points. So you have to consider, and this is in the statute, right? So you need to consider the consumer's amount and source of income, length and nature of the employment, fixed expenses, variable expenses, other debts that need to be repaid, credit history, age and number of dependents, assets, reasonably foreseeable changes in geographical factors. So you need to consider all of that. In terms of the objectives, you need to figure out why do they want the loan. For what is the time frame, what is it that this loan is going to address, whether they need particular features, right? So if they want a loan where they can draw it down and repay early, and you're giving them a loan that doesn't have that flexibility, then that doesn't make sense. So you can see an example that was put up as well. And interestingly, we've got a court case that has just been sort of in the works and continues to be in the works. So in the Royal Commission, this area got covered quite a bit. As I mentioned, in the Royal Commission, regulators were being criticized for not enforcing the law. And so regulators then started to take law a lot more seriously and try to enforce it. So in terms of the responsible lending, ASIC looked at the obligations to assess capacity to repay. And they said to Westpac, your processes did not meet the requirements. And what the core disagreement was about is this. There is what's known as the household expenditure measure. So this is a benchmark of what a typical household, what their typical expenditure is. Right? So this is just based on population statistics. So if I'm the bank and a customer comes to me, completes my application form, and they say that their household expenditure for the year is $60,000. But according to the HEM, the average expenditure for this type of household is $50,000. And then I make them a loan for $500,000. So in making a loan, if I use the household expenditure measure and not the amount that they actually said that they're going to, that their actual expenses are. Question is this loan unsuitable because I haven't fully taken into account their capacity to repay? So ASIC said during Royal Commission, yep, we take a view. We have to, if the person says these are my expenses, right? You have to base your assessment on the actual expenses of the person. If that's what they said. So historically, the problem was that whenever people used to fill in the application, they would always minimize their expenses. And that was always the case. Because people want to borrow more, or they want to have the flexibility to borrow more, everyone used to rely on the forms. And often the agents, the mortgage brokers and the agents, they would facilitate this. They would tell you what to write. Okay? Then, people kind of started to get pushed to complete them more seriously. It's a legal document, you can't rely on it. So then, all of a sudden you have now cases where people complete it and they end up with a number that's bigger than the median. So ASIC took on Westpac, and originally they actually Westpac agreed to pay a fine. Now, they agreed that they've breached the law and they agreed on the fine, or they've agreed that they haven't done something. Right? But then that agreement had to be approved by the court. And the judge looked at what they agreed, and said, well, if I look at what Westpac is agreeing to on the facts and what they're agreeing to as the conclusion, I don't agree that it makes sense. Because the facts that they're agreeing to does not make sense for the conclusion. So therefore, the settlement that you have agreed on, no deal. Either ASIC, you take them to court and you actually allege that they've breached the law, or you can't take action against them. So ASIC was disappointed, and ASIC then took legal action against Western. Big announcement, big legal action, and we're talking about 260,000 loans. And the judgment was handed down only about a couple of months ago. And this is a very big judgment. And that judgment is known as the Wagu and Shiraz judgment. Because the judge used this phrase to say, well, look, it doesn't matter to an extent what people say on the form. Because my expenses right now might be very high if I choose to eat, the Wagyu beef and wash it down with the best bottle of Shiraz every night. If I do that, then my expenses are going to be very high. But if I want to buy a house, then I might just downgrade to McDonald's. Right? So my expenses might actually fall. So it's not so much about what expenses people put down, but rather trying to understand what are the unavoidable expenses. So of the different expenses you face, what are the expenses that you can't get out of? And then he said, but besides, let's not look at the formalities of what you do with the form. The ultimate obligation is not to make unsuitable loans. That's the ultimate obligation. So you can't just say you use the wrong benchmark, therefore all of those loans are unsuitable. Right? The point is, the obligation is not to use the right benchmark, the obligation is to not make unsuitable loans. But it does mean that if you do make an unsuitable loan, the risk comes back to the bank. And ASIC was very disappointed with that outcome, so they're currently appealing that decision. So it will be interesting to see how they succeed. Now, in terms of the Banking Royal Commission, this whole idea about what to do did get quite a bit of airing. Because, as I said, this whole idea, if you ever applied for a home loan beforehand, there would always be this pressure to say things on the application form that may not be true. So, in the Royal Commission, they said that the use of a benchmark is not a replacement for making inquiries, nor a replacement for an assessment based on their verified income expense. Because the other alternative was where people just did not actually make the inquiries and use the benchmark instead. Right? So, or in one bank's case, they made the inquiries, but that information didn't actually go anywhere at all. So in that case, if you're collecting the information and you should have known that this person has no money, but you're not using that information in that way, then you will have an unsuitable loan. Interestingly, the way to solve it from a Royal Commission perspective is this one of the first recommendations, and that is to say, when there's a mortgage broker, the mortgage broker right now acts in their own interests. And you may not realize it, but that's actually the case. The mortgage broker does not have an obligation to act in your best interest. And the recommendation was to make sure to introduce a new obligation for mortgage brokers to act in the consumer's best interest. All right, so that's retail loans. Corporate loans. So for corporate loans, they usually have a fixed structure and fixed of disbursements, so when the loan gets drawn down and when they get repaid. The difference, you've got secured and you've got unsecured. So secured, if there's a default, you get access to a particular asset. If it's unsecured, then you just become a creditor. You can have a senior facility, in which case you outrank other general creditors. Pari passu is a term that means in line with others, so on equal ground, or you can have subordinated. Subordinated is below others. When you look at credit risk management, you look at collateral type, level of seniority, term, schedule of payments. For large loans, you can syndicate them as well. So when you're then trying to, if you've assessed your risk, how do you manage and mitigate your risk? And you can do that through limiting risk, reducing risk, or pricing for credit risk. So, in terms of limiting, from a limiting perspective, you are going to address this through origination. And this is where you have to decide who is going to be your clientele, right? So, what kinds of clients you're going to deal with. There are, for example, if you watch TV, there are a lot of ads, and there's all these ads for small short-term loans, where they say, hey, your car needs fixing and you don't have any money, you can borrow from $500 to $5,000 with us within 24 hours. Now, where do you think those loans are on the risk scale? Are they low risk, medium risk, high risk?
High risk,
Why?
because business originations, there's a lot of TV.
So there will be an origination process. By law, they have to do an assessment. Right? By law, they have to assess. But question remains: low risk, medium risk, high risk. If somebody is advertising, imagine you have an unexpected expense, your fridge is broken, or your car needs replacement, or you need an urgent surgery, we can lend you from $500 to $5,000 within 24 hours. Do you think this lending is low risk, medium risk, high risk?
Still think it's high risk because, if you are on the low risk, you will go to banks, credit card, why lend from there?
It's the right answer. It is high risk, and that's part of the answer. Is why would you borrow from them if you could borrow from the bank? But the other problem is, think of it this way: if you need to borrow $500 urgently, and you have to go to the bank to borrow $500, then probably managing your money is not your strong suit. And imagine, think of yourselves and think of people you know. If you wouldn't be able to find $500 to urgently because something happened, right? Or think of anyone that you would think that wouldn't be able to do it, then would you actually lend money to them? So that's high risk lending. Right? Now that high risk lending will come with higher rates. So this is where you have your own risk appetite. A lot of large institutions are not going to do this type of lending, but other institutions will. So this is where you define what kinds of risks you're willing to take. In the US, we had these subprime lenders. In Australia, we really didn't have them. Right? In Australia, if you have a bad credit history, none of the major banks are going to touch you. Whereas in the US, you go to a bank and they would say, oh yeah, no, we actually have a product for you as well. We have a subprime product. Right? So that's the origination. And then you can also have limits. So you can limit the amount of risk you pay through limits. And those limits can be by industry, it can be by the exposure to a particular counterparty. So all banks have counterparty limits. To say, look, I like you, but I'm not going to have more than 500 million exposure to you. Right? And that exposure is across all the relationships that we make. You may have industry limits, country limits. You might say, in terms of global mining, I don't want to lend to global mining more than 10 billion global. Right? So if you're like Citibank, you could have that sort of limit. And those limits work to optimize your overall portfolio. The next way to mitigate your risk, credit risk, is to require collateral. Now again, coming back to the GFC and coming back to why the problem in the US was so profound, and that's because they did not stick to the basics, to the credit risk management 101. And credit risk management 101 is that when you lend money, your primary defense is making sure the person has the ability and the willingness to pay back. You should never lend money to someone who doesn't have the ability and the willingness to pay you back. Collateral is a secondary defense. Collateral is there to protect you if the person doesn't pay you back. But when you make a loan, you should be expecting genuinely that the person will pay you back. But then to mitigate your risk, you can consider collateral. So then in terms of collateral, the better the quality of the collateral, the more valuable it is. So cash is the best collateral. Right? CGS is Commonwealth government securities, so government bonds. Bonds are better than shares. Right? Shares are much more risky. So the better the quality of the collateral, the less risk you will have. And you would then apply different haircuts, so different discount ratios, depending on the type of collateral. And the credit rating of your counterparty will also be important. Right? So you might say, the riskier the counterparty, the more collateral they have to provide. So that's where your credit risk rating is quite important. So what you saw happening during GFC is investment banks would have to give collateral. So if I'm rated single A and I'm trading with you, I have to give you, say, 10 million of collateral. But if I get downgraded to triple B plus, all of a sudden I need to give you an extra 10 million of collateral. And if I get downgraded to double B, to give you 60 million of collateral. So, as you get downgraded, there's more and more resources that are required from you. So that's that's the rating element. And then we get into a little bit of managing risk purely in a trading environment. Right? So we'll come in a trading relationship where you trade between two entities. Let's say we've got party A, we've got party B, and they agree on a fixed or floating swap. And let's say this is a 3-year swap. Right. So historically, if it's a 3-year swap, where is the credit risk? This is 0, 1, 2, 3. So I've entered into a 3-year swap. How's my credit risk profile looking? We'll cover swaps.
Are we institution A or B?
Let's go A. Doesn't matter.
I think B is like basically because we receive fixed pay floating.
Okay. So what's my exposure to credit risk? How would you describe my exposure?
Increasing. The first year is lower.
What's my exposure to credit risk here? What do you think? Right. Again, what's credit risk? Credit risk is the risk I don't get paid. Right? So ultimately, we need to figure out when am I expecting to get paid, and is there a risk I won't get paid. So historically, say for a swap, you look at how frequently the payments have to be changed. Swap might be quarterly, but let's say annually. Right? So let's say here we're expecting to have 3 payments. 1 payment in year 1, 1 payment in year 2, 1 payment in year 3. You know that the value of the swap will start changing after day 0. Because the fixed leg will stay the same, but the floating leg, right, the expectations of the floating rate might change. Right? So if I am paying fixed, receiving floating, what if the floating, variable interest rate is going up? If the variable rate is going up, I'm expecting to receive more. So that's good, right? I'm expecting to get some money. So the value of the swap is going up, but as the value of the swap is going up, my credit exposure is going up. So imagine I've done a swap with you, and I picked the right side, so the interest rate is going up. You owe me money by the end of the year, right? You owe me money, that's great, but the more money you owe me, the greater the risk that if you default, I don't get paid. That's my risk. So how can we settle this risk? How can I reduce this risk? Well, I can reduce this risk by saying, how about we don't wait for these points, how about we reevaluate the value of the swap each day? So on day 1, if I'm winning and you owe me 50,000 under the market provision, then you pay me 50,000 and we revalue the swap. And on day 2, if I owe you 30,000, I'll pay you 30,000 back. So instead of waiting to have large exposures, you settle, you reprice these exposures on a daily basis. That's what it's called by daily mark-to-market with daily net payments. So the idea is, imagine that this is Goldman Sachs, this is Morgan Stanley. Chances are they have hundreds of transactions between them. Right? They have hundreds of transactions. So if, and this is kind of the post-Lehman Brothers, if you wait when these transactions mature to settle, then God knows what credit exposure you're going to get. Whereas, if in this bilateral relationship, at the end of each day, we work out how much money, let's mark to market all of the transactions. Let's work out how much money you owe me, how much money I owe you, And then let's just make one net payment. So if looking at 100 transactions, under those 100 transactions, we might work out that you owe me 17 million and I owe you 19 million. So all we do is I transfer 2 million to you and we reprice all of the transactions to today's rates. So therefore we start tomorrow with zero exposure. Now to achieve that, you need a couple of things. One is you need to have a legal agreement that will cover all of these transactions. And that's what an ISDA agreement is about. That's why ISDA is very important. Every single large bank and every single trading bank has multiple ISDA agreements. So it's something that everyone does. So we have an agreement, and under that agreement we have a process to do the daily mark-to-market, daily net settlement, and also we can figure out what's the minimum amount we're going to transfer. So you might say, look, if it's under 1 million, we're not going to do the transfer. If it's more than 1 million, we will do the transfer. What else can we do? What else we can do is we can have early settlement in case of a credit event. So if we have a 3-year swap, we do these daily mark-to-market, but imagine that at this point you get downgraded or you actually become bankrupt. I don't want to wait for the end of the 3rd year to settle the transaction. I don't want to go through the daily settlement if you're going to be in default. So this is where, into the agreement, we can actually incorporate a term to say, hey, by the way, if you get downgraded below single B, or if you default on any obligation anywhere in the world, we terminate all of our transactions. That's early settlement in the event, in case of a credit event. And by the way, that's also incorporated into an ISDA agreement. So the most common one is an ISDA, and that covers usually entire relationships. And then there are also specific agreements if you only do particular types of trading. So you've got MRAs, GMRAs, short form effects. So short form effects is just if we're trading effects. And GMRAs and MRAs is if we do repurchase agreements. So Reserve Bank, they use MRA agreements for domestic repos. So in terms of the master agreement, as I said, you've got the netting of exposures. So all of the different transactions get included, and then you calculate the net position. You work out, what is the cross default, so how much you can default on one before everything gets defaulted, and how to close out all of the positions if there is a default. Right? So, as I said, you've got the agreement, and then you've got this collateral support connection that does the daily mark-to-market and the collateral transfer, and then also talking about what collateral is required to support the positions. So that's again, this is how you mitigate your risk. Right? And then the next element is looking at how do we price for credit risk, right? So in terms of pricing for credit risk, we're looking at better rated companies get better, they get better prices. Right? So they get lower rates on lending. And from a bank's perspective, this makes sense because you're not looking at your gross revenue, you're looking at your risk-adjusted returns. So lending to a lower risk company at a lower rate might still give you a better risk-adjusted return than lending for a slightly higher rate to a much higher riskier company. Right, so that's just the general discussion about credit risk. So now we come to the actual capital models. So in Australia, we've got the two prudential standards, APS 112 and APS 113. So 112 is the standardized approach, and 113 is the internal approach. And the internal approach has two sub-models, the foundation and the advanced. What do they look like? The standardized approach is what we covered last week briefly. So the standardized approach is the basis for the Basel framework. Ultimately, you take the book value of the asset, multiply it by the risk weight. If there is a credit enhancement, right, so anything to do with credit risk mitigation, such as collateral guarantee, lender's mortgage insurance, then that might reduce the amount of credit risk. And off-balance sheet items need to be converted using the on-balance sheet equivalent. So, I thought we're going to use the actual tables from the actual prudential standard. Right? So this is from the actual APS 112. I have simplified the wording a little bit, right? So, because the actual explanations of the items are very long. So, first ones are cash items. So notes and coins, 0% risk weight. Balances with the Reserve Bank, 0% risk weight. Gold is considered to be equivalent to cash, 0% risk weight. Cash in the process of collection. So any unsettled transaction, 20% risk weight. This is what we talked about as the first step risk last week. Claims on government and central banks. So Aussie dollar claims on Australian government, 0% risk weight. Generally speaking, local currency claims on central government is 0% risk weight pretty much everywhere. Why?
They can print money.
Because they can print money. That's exactly right. It's very hard for the government to default on obligations in their own currency because they have the right to print. So if you're in Zimbabwe, you print, the $1 trillion notes and the quintillion dollar notes. Right? In Zimbabwe, they ran out of, I think I told you, they ran out of space to put the zeros on the banknote. Where you start to be like, you have a single digit in the right-hand corner, then you've got 1,000, million, billion, trillion, right? So eventually the number becomes so large, fills up the whole bottom of the banknote. But you can print more money. Normally when countries default, they default on obligations in the other currency, in the foreign currency. So any other claims, so this is all claims on state governments, regional governments, and central governments, and central banks, as well as foreign exchange claims on Australian government. So state, for example, if you lend money to the state of New York, state of Alabama, or if you lend to New South Wales government. Regional. So, some countries work on regions, right? So, I don't know, if in France, if you if you lend to province, regional government, and central government. So if you lend to any other overseas government, central government, or central banks, as well as any foreign exchange claims on the Australian government, so US dollar loans to the Aussie government. Any of those, the risk weights depend on the credit ratings. So APRA introduces its own credit rating system. So the credit rating system is this. This is the actual credit ratings that we have. So AAA and AA is equivalent to credit rating grade 1. Single A is credit rating grade 2. Triple B is rating group 3. Double B is 4, single B is 5, and triple C all the way to D is 6. Right? So, going back, so now we look at if we're lending to the Australian government, which is rated AAA, right, then it's always going to be 0, whether it's foreign currency or local currency. If you lend to state government that's rated AA, that's still going to be 0. But if you lend to a government that is rated single A is group 2, so therefore you have to apply 20% risk weight. Claims on local government. Again, the terminology might be a little bit new to you. Does anyone know what local government is? What's the local government in Australia?
Council?
Council, absolutely right. So in Australia we have 3 levels of government: federal government, state government, councils. So in the US, that's probably known as municipality. So if you lend to a particular municipality, that would be classified as a local government. In China, that would be the city level. So if you lend to an authority established at the level of the city, that would be local government. So you can see that the ratings are somewhat different, right? So that's government. So the next one is claims on banks. So claims on banks, you've got the first one, international banking agencies and regional development banks. So this is your IMF, World Bank, Asia Development Bank, European Bank for Reconstruction and Development, right? Those types of institutions. And then you've got claims on banks less than 3 months and claims on banks more than 3 months. Right? So if you've got something like a 90-day bank bill, then that will be classified as a claim on bank less than 3 months. But if you've got a 1-year note, then that will be classified as claim on banks more than 3 months. And you can see that less than 3 months, ratings group 1, 2, and 3 all get 20% risk weight. So that means triple B rated bank, their bank bills get the same risk weight as a AA rating. So that's quite an important one. Then you've got claims on corporates. So claims on corporates is our claims on any lending, any exposure to corporate clients. So again, 20%, 50%, etc. Fixed assets is 100%. Margin lending against listed shares 20%. All other assets 100%. So fairly straightforward. The ratings we covered. Now, residential mortgages have their own category. So for residential mortgages, this is the current table, but it is subject to revision. And you can see where originally the 80% loan-to-value ratio was established and how that's been changing over time. So right now in Australia, if you have standard eligible mortgage, meaning that standard loan, no defaults, fully verified income. So you don't need loan mortgage insurance, and if you've got 80%, up to 80% lending, then the risk weight will be 35%. If you go to up to 90%, the risk weight goes from 35% to 50%. But if you get loan mortgage insurance, it goes back to 35%. So from a bank's perspective, they're saying, we can lend you up to 80%. And that will take you to 35% risk weight. But if you want to get more, we don't want this, we want then this. That's where you get an LMI. But you can see that up to 100%, your LMI will still be higher. So if you go above 90, up to 100, chances are this is where the bank will actually force you to pay more. They will say, we can lend you, but you will have to pay more. That's for the standard eligible mortgage. For the non-standard eligible mortgage, you can see that, for example, if there's no verified income, right? If they can't verify your income, generally speaking, they will lend major banks up to 60% with loan mortgage insurance. That will still keep you in the 35% risk weight. Now this is, remember, this is the standardized approach. Who uses the standardized approach? Small banks, correct. Not large banks. So for large banks, they use the internal approach. And in the internal approach, they have to figure out their own categories and their own risk weights with the approval of the APRA. But this is the standardized. Now you can see that under the standardized, there is no distinction between owner-occupied and investment loan. So that's quite interesting. And that's why historically, even after the GFC, the lending rates on investment loans and owner-occupied loans had been the same. And it only started changing after APRA made some comments about it. And that really applied to large banks, and then having applied to large banks, all the other banks have done the same. So right now there is a distinction in pricing between owner-occupied and investment. Generally speaking, investment loans get charged about 40 basis points more than owner-occupied loans. But historically that wasn't the case, and under the standardized risk weights, there is no distinction. For off-balance sheet exposures, as we said, different conversion factors for derivatives and non-market related instruments. And you multiply the off-balance sheet item by the conversion factor. And then you multiply the converted amount by the risk weights based on who the counterparty is. So this is the table that I showed you last time. As I said, this is the actual table in the current Australian Prudential Standards. So this is what you use on the standardized approach. It doesn't get used very often because banks that are subject to standardized approach generally don't trade a lot of derivatives. So that we've got our conversion factors, and these are the conversion factors for non-market related items. Now, as I said, these are off-balance sheet items. And as we covered last week, why do we have off-balance sheet items? We have off-balance sheet items because they are uncertain. We don't have sufficient certainty that there will be an actual exposure, an actual payment required. So, direct credit substitutes. Does anyone know what's a direct credit substitute? Not so much a swap. A swap is you've got an agreement. Direct credit substitute. So in what circumstances will I substitute my credit standing for yours? Guarantee. Right? So if I provide a guarantee, right? So imagine if you owe $100 and I guarantee that you will pay. If I guarantee that it's my credit standing covering your credit standing. So that's a direct credit substitute. That's a guarantee. Performance-related contingencies. So contingency meaning it might happen. Right? Performance-related, this is where, let's say, one company promises to do something. We will complete this project by the 31st of December. And if we don't complete this project, then we pay a penalty of $1 million. And here's a guarantee from my bank that if we don't complete this project, we'll pay a penalty. Trade-related contingency. We will deliver, 1,000 heads of cattle to this port by the 31st of March in good condition. Okay, here is a guarantee. Right, so anything to the trade-related contingency, 20%. Lending of securities or posting of securities as collateral. So if I lend securities to you and I expect to receive them back, then that's pretty much the same as a direct loan. So the conversion factor is 100. Again, remember, these are conversion factors into on-balance sheet equivalent. Assets sold with recourse. What's recourse? Again, it's a old banking terminology. Has anyone heard about it? With recourse or without recourse?
You have to, before you pay back part of your principal.
Okay, so recourse and non-recourse. Imagine I sell your car, right? If I sell your car with no recourse, meaning that if it breaks, it's your problem. You have no recourse back to me. Whereas if I sell something with recourse, it means if it doesn't work, you can recourse back to me, you can bring it back to me. So with loans, this is quite important. Because I can, imagine somebody owes me money. Imagine someone owes me $100 in 3 weeks' time. I don't want to wait 3 weeks. Instead, I say to you, I'll sell this to you for $95, but you pay me $95 now. No recourse means if the other person doesn't pay, it's your problem. With recourse means in 3 weeks' time, if the person doesn't pay, you give the loan back to me, and I have to give you back $95. That's the difference with recourse or without recourse. So the whole idea of securitization is under securitization, as we will see, the bank, the originating bank, is selling loans to the securitization trust on a no-recourse basis. It's a final sale. If there's a problem with the loan, it's your problem. Okay? So if you sell assets with recourse, then the conversion factor is 100%. You still face the entire credit risk. Forward asset purchases is if you're buying an asset in advance, partly paid shares and securities. So if you only pay, then you need to pay more later on. Placement of forward deposits. So again, if you're paying money but at a later point in time, so there's an obligation. Note issuance and underwriting facilities. So if you are underwriting something, what's an underwriting facility? Does anyone know?
Sort of like guarantee, so it's guarantee someone is not paying, it's your responsibility.
So in a underwriting facility, in an underwriting facility, so imagine we want, let's say, ANZ Bank. Right? They want to issue bonds to investors. And let's say they want to issue 800 million. Right? The risk they're running is what happens if they can only find investors for 600 million, but they need 800 million. So they will be working with their advisors. Right? So let's say they hire Citi as an advisor. And Citi says, yes, we will enter into an underwriting agreement. So an underwriting agreement will be to say, Citi will try and find investors, but if there is a shortfall, if there's only 600 million investors and they want to sell 800, then Citi will buy whatever is remaining. So the remaining 200. Right? And when you have an underwriting agreement, we generally talk about hard underwrite or soft underwrite. Soft underwrite, which is to say, I will use my best endeavors to find investors. So it's not an actual hard commitment, but it's a promise to use your best endeavors. Hard underwrite means that you will say, I will try and find investors, and if I don't find enough investors, then I'll make up the remainder. So whatever is the size of your underwriting commitment, if you're saying it's up to 800 million, then that 800 million will be your own balance sheet. Will be the amount that you've agreed to do. Other commitments. Commitments with certain drawdowns. So if you made a loan that has drawdowns every 6 months. So if there's a certain drawdown, it hasn't happened yet, but it will happen, therefore the conversion factor is 100%. Commitments, i.e. undrawn formal standby facilities and credit lines with an original maturity of 1 year or less. So this is, if you have a credit line, and we discussed what credit lines are, so if you have an ability to borrow, and the original maturity is 1 year or less, the conversion factor is 20%. More than 1 year, the conversion factor is 50%. And if you have a commitment that can be unconditionally canceled at any time without notice, or effectively provide an automatic cancellation if there's a deterioration of the borrower's profile, then the conversion factor is 0. Right? So these are the conversion factors. All right, let's take a quick break. Quick break, and grab some water, and then we'll knock off the second half.
Haven't heard anything back yet, but I'm following it.
If you have any information,
I will.
yeah, approach you or you can.
No, no worries. Yes.
I have some personal problem. This is a final semester for me, and I applied in job in China, and they asked me to go back to China. It should be this month, actual day. Yeah, because I apply around 15 companies for consulting form, and they told me generally around October, after the holiday of China. And after the holiday, they tell me the actual day, so I consider it as there is some conflict between the meetings and the interview.
Let's deal with the problem when we know about. Once you know the dates.
Yeah.
You let me know.
Yeah. It is condition you have to apply for special confirmation.
I'm already finding out. Somebody already spoke to me about it. In a similar situation, so I'll ask the question.
Thank you very much.
Hey.
Hi, Anandra. Just want to introduce myself.
Anatoly.
Enjoy the lecture so far. But for the rest of the course, for the lecture, I realized that there were a lot of numbers in it.
Yeah.
Would you be like describing it in various details and everything? Besides the lecture recording, because I'm feeling a bit unwell, so I might have to.
That's fine. I mean, it's good the recording, so we'll do some of it on the board, but it's not a problem.
Okay, I see. Yeah, it's just not for me. So
Yeah, it's fine.
Anyway, Anatoly, is it?
Yes.
Thank you very much. I haven't introduced myself from the start, so.
That's fine. That's fine.
Anyway, thank you, Anatoly.
No worries.
I'll see you next week.
Hopefully
Thank
you
you.
feel better.
Hopefully. Thank you.
Yeah.
Bye-bye. Don't want to get this worse. Thank you.
feels like weekend like you can need to ground for all the tutorials. Yeah, like days on it feels like the same feeling, right? 所以等到下午7点左右。
我就问回来全哥。
没有，我第一个来的好，我是第一个来的。
你下去买两个。你带信息了？我酸奶都不行。你醋比较多。他醋的我确实想的，我就想要看蜜和奶，聪明，怎么可能呢？你想吃就胖。哦，What is it? What you完全没有。录完就觉得放假了，又是一个小时开始开始。对啊，我们就是放口气，熬过了就这样。
今晚上是不是很好上课啊？可以，为我帮上多点我一直给你编，你天天跟我谈。
我今天下午我看了一下提出血型，每一考都算了，我不走。英语没有他怎么能我不知道做不了。
但是你要找到
All right. All right. Let's get through some of these examples and calculations, just to make sure that you can see how it works. And actually, I just realized that I've got the Excel file with all of these calculations, and I'll try and upload it tonight, just so that you can see the calculations themselves. So, here is a typical question, right? So, what balances with the Reserve Bank, transactions pending settlement, Australian government bonds, Macquarie bond, and the Telstra bond. So we have assets on the balance sheet of 320 million. So risk weights, balances with the RBA, what's the risk weight? 0. Transactions pending settlement. 20%, correct? Australian government bonds. 0, correct. Macquarie. So Macquarie, what's Macquarie?
Corporate coverage, 100%.
Macquarie is a bank, right? So again, I'm kind of using terminology like Macquarie Bank. I expected everyone to know that Macquarie is a bank. And I remember at one stage I did a question and people go, "No, using the wrong category." I'm like, "What do you mean I'm using the wrong? I'm using the right category. You're using the wrong." Right, Telstra. Everyone knows Telstra. Yep, yeah, that's a corporate. All right. So in terms of Telstra and Macquarie, so Macquarie it's a 6 months to maturity. Telstra is a 3-year bond. So let's have a look. When we look at it, so banks, claimant banks, more than 3 months, and risk rating. So what did I say Macquarie was? A. Yep. So if it's A, then that would be 2, so therefore 50%. And for corporates, Telstra was also single A. So single A would be 2. It would also be 50%. So the question is, if they calculate the risk-weighted assets, and if the prudential capital ratio is 11.5%, how much capital do we need? Right? So we apply the risk weights, we calculate risk-weighted assets. So out of 320 million of balance sheet items, the actual risk-weighted assets are 35, and the minimum capital, therefore, is 4 million. So therefore, if you were to look at that pure balance sheet, right? So if we had 320 of these assets, then we would need to have 4.025 in equity, like in capital, and then the rest would be debt. That would be, 15.075. So we could have that much debt in order to support that much in assets. Is that a realistic balance sheet structure? Well, apart from obviously, missing all the other assets, what would be the other key requirement that will drive the amount of capital? This is brownie points from last week. Which part of Basel III? What's the other restriction?
Other risk.
Off balance sheet.
8% is the prudential capital ratio, right? So in which case it's not even 8, it's 11.5. So we took that into account. What's the other key method, key requirement that got introduced last week? And you can't look at last week's slides, it's cheating.
1%.
What is it? Leverage ratio, correct. And what's leverage ratio? Of? Total asset, correct. So leverage ratio is non-risk weighted. And if you think about it, like this example is good to illustrate that point, right? Basel framework is about risk-weighted assets. So looking at that size of the balance sheet, we go, it doesn't matter what the size of the balance sheet is, let's look at the risk-weighted assets, and in this case, we only need 4 million of capital. But if we did, what's 3% of this, of 320? 9.6, right? So if we applied leverage ratio, then the minimum amount of capital on the leverage ratio would be 9.6, more than twice the amount of capital under this. That's why leverage ratio is there. Leverage ratio is there as a backstop, non-risk weighted. All right, question 2. Same balance sheet, but 3 months later. And assume that instead of Australian government bonds, we have Japanese government bonds. And Telstra got downgraded as well. So the size of the balance sheet is the same. It's also 320. So what happens now? Well, what happens now is balances with the RBA, still 0% risk weight. Transaction spending settlement, still 20%. So balances with the RBA 0, transaction spending settlement 20. Japanese government bond. Japan is rated single A. So that's credit group 2. Therefore, the risk weight is 20%. Macquarie bonds, so now, let's say it's just less than 3 months. Right? So if it's, the risk weight is 20%, but Telstra got downgraded, so they're now triple B. So being triple B, that puts them into risk category 3. Therefore, the risk weight there is 100%. So if we do that, then the risk-weighted assets are now 76 million. And the amount of capital is 8.74. But if we apply the leverage ratio, it would still be 9.6. But you can see that ratings now make a difference. Question 3, off-balance sheet items. So from an off-balance sheet item perspective, let's say we have 6 months equity option with Macquarie Bank. 2-year FX swap with Commonwealth Bank. A bank guarantee in relation to Rio. A trade letter of credit for BHP. And the 3-year undrawn line of credit to Telstra. Right? So the total size of the off-balance sheet items is 1.010. Right? So over 1 billion. So now we have to assess it. 6 months equity option. 6 months equity option. Let's look at. It's an equity contract, right? So it's not an interest rate, it's not FX, it's not precious metals. It's an equity contract, and it has 6 months to maturity, 1 year or less. Therefore, the conversion factor is 6%. Right? Two-year FX swap with CBA. So going back, this is an FX swap, so it's a foreign exchange contract, and it's for 2 years. Therefore, the conversion factor is going to be 5%. Bank guarantee. Does anyone remember the conversion factor for bank guarantees? What's a bank guarantee?
100%.
100% because it is a direct credit substitute, correct? Trade letter of credit. What's the category? Third one. Trade-related contingency, correct? And 3-year undrawn line of credit. So that would be 10B2. Undrawn line of credit, 2 years to maturity. Right? So, what do? So we apply the conversion factors. So 6%, 5% guarantee, 100% trade-related contingency, 20% undrawn line of credit, 50%. Once we apply them, we get the on-balance sheet equivalent. So this is now the equivalent of being on balance sheet. after we have this, we now have to apply the actual risk weights. What do the risk weights depend on?
Credit rate.
And the type of your counterparty. Right? So this is where people sometimes get confused. For off-balance sheet items, what the item is determines the conversion factor. Who the exposure is to determines the risk weight. So whether it's a CBA or Westpac or Telstra doesn't determine what the conversion factor is going to be. But once you've converted, then it matters. So we've converted. So now with Macquarie single A rated, and it's a 6 months. So it's more than 3 months, and it's category 2, right? So bank. Claims on banks more than 3 months, category 2, risk weight 50%. CBA is rated AA minus. So AA minus is risk category 1, and it is a 2 year, so more than 3 months, but risk category 1, it's 20%. Bank guarantee for Rio. Rio is a corporate, it's rated single A, A minus. So A minus means that it's a credit rating 2, and the conversion and the risk weight is 50%. BHP, same thing. Telstra, same thing. So ultimately, these last 3, Rio, BHP, and Telstra, they're all corporates. And they're all rated in a credit rating 2, so their risk weights have to be the same. So now, we start with this much. So we had, this is the off-balance sheet items. That converted into on-balance sheet equivalent of 210, 235, 236.1. Right? So 236.1 of on-balance sheet equivalent assets, and then that 236.1 was converted into 110 of risk-weighted assets. And then if we apply 11.5% minimum minimum capital ratio, that gives us about 12.7 million of minimum capital. So for a bank, you have to take into account off-balance sheet items and on-balance sheet items. Question 4. We've calculated the amount of capital. Does that level of capital ensures that the bank will not become insolvent? Question to you. We've calculated the capital. Does that mean the bank will not be insolvent? And the short answer is it doesn't mean that at all. If you looked at the report into Lehman Brothers, 6 months before it collapsed, the regulatory agencies in the US classified Lehman Brothers as well capitalized. And it was meeting all of its Basel obligations. Just because you're well capitalized at the time, like in this case, we've done the calculations, but we have 11 million, or in this case, let's say 12.7 million in capital. But imagine that Rio Tinto suffers a disaster and they go bankrupt. And that could easily happen. If that happens, you know, you're losing 100 million, you're done. So you never know. Right. What about the internal rating-based approach? So that's the standardized approach, right? Not a lot of banks use that in Australia because all the big banks use the internal approach, but it's a very sound approach in terms of the structure. That's what makes sense. All right, so in terms of the definitions, we've got the credit obligation, which is the agreement where the borrower gets something and they agree to repay. And then you've got these three key definitions. Exposure at default, loss given default, probability of default. And if you think about it, your expected loss equals to exposure times loss given default times probability of default. Now think about it. How much money do I expect to lose? Well, if I lend you $100 and there's a 10% chance, right? So if I lend you $100 and there's a 10% chance that you will default, and loss given default is the loss if there is a default. So imagine if there is a default, I lose 60% of that amount. Then how much do I expect to lose?
6.
How much? 6.
6.
Right? I expect to lose $6. So it's actually brilliantly simple. And if I expect to lose $6, what am I going to do with this amount? What I make? Provision. Exactly right. So when I make a loan, I need to calculate my expected loss, and that will go into the provision. I need to provide this much. I need to set aside this much to cover my expected losses. So, in terms of the internal ratings-based approach, right, ultimately you do calculate the expected loss and the unexpected loss. And the expected loss is covered by provisions, unexpected losses are covered by capital. You've got the foundation and the advance. In terms of the foundation approach, APRA provides the model to calculate exposure, because calculating exposure is not always straightforward. For some loans, if you actually lend money out, you kind of know, but for some other lines of credit, for example, right, if you're trying to calculate what's your exposure going to be if somebody defaults under a line of credit, it's not that obvious. What other losses are going to be incorporated? Not that obvious. So under the foundation, APRA gives you the calculation for exposure, and they also give you the calculation for loss given default. But you calculate the maturity of your exposure and you calculate probability of default. Under the advanced IRB, you calculate everything yourself. And interestingly, under the internal ratings-based approach right now, you add up all the risk-weighted assets, and then you multiply it by 1.06 as a scaling factor. We will cover the formulas, but I don't expect you to memorize them or to actually have to use them. But this is the actual formulas. So to work out the amount of capital, you actually come back to the Markowitz theory. because you're not so much looking at how much capital you will need for a single exposure, but rather for the portfolio, how much will you need? And that does relate to the correlation. So you can see that correlation relates to the multiplier, probability of default, and probability of default. You also have the maturity adjustment, and then you've got the calculation of capital. So the calculation of capital takes into account different distributions, correlation, probability of default, loss given default, and the maturity multiplier as well. And then you've got the actual calculation of risk-weighted assets. So if you work backwards, the calculation of the risk-weighted assets is this much capital times 12.5 times exposure to default. That will give you the equivalent of risk-weighted assets. Because you need risk-weighted assets to calculate your overall capital requirements. But you also calculate the actual capital that you will need. So, kind of looks a little bit like a complex calculation. In reality, for people that deal with these loans and that do the calculations, it's relatively straightforward. The issue is more around actually working out the probability of default. And loss given default is generally stable. Right? Exposure, you sort of know what it is. So the factor that will really drive your calculations is the probability of default. So, let's look at how to calculate probability of default. So, when we want to look at the probabilities of default, the very first avenue that everyone will go to is the rating agency. Right? So if you think about what's the probability of default if something is AAA versus something that is AA. Interestingly, rating agencies say that the probabilities of default, the ratings are not a reflection of a probability of default. However, that's exactly what everyone is using it for. So let's actually look at the definition of a rating. I think I've taken it from Fitch, but it's not that, it will be very similar to say S&P. So, for example, AAA. AAA represents the highest credit quality, and it denotes the lowest expectation of creditors. It doesn't say lowest expectation of default, lowest expectation of creditors. They are assigned in cases of exceptionally strong capacity for timely payments of commitments. This capacity is highly unlikely to be adversely affected by foreseeable events. So in other words, they have the ability to pay back, and that ability to pay back is not going to be impacted by anything that is foreseeable. So we expect the economy to turn down. That's fine, they should still have money to pay. A meteor will hit the earth and will wipe out, the bank's operations. That's not foreseeable. So anything that's foreseeable should not impact the capacity to repay. AA, the capacity is not significantly vulnerable to foreseeable events. Single A, the capacity may be more vulnerable to changes in conditions. Right? So if there is a change in conditions, it's more vulnerable than the others. And BBB, the capacity for timely payments is considered adequate, but adverse changes in circumstances are more likely to impair this capacity. So if there's a negative downturn, it's more likely that the capacity will be impacted. And then you can look at BB, speculative, indicates there's a possibility of credit risk developing. securities rated are not investment grade. Highly speculative. So for highly speculative, capacity for continued payment is contingent upon a sustained favorable business and economic environment. Yes, they're paying their debts, provided the current environment is favorable and continues to be favorable. And then triple C, default is a real possibility. Capacity for meeting financial commitments is solely reliant on sustained favorable business or economic developments. Double C, default is probable. C signals imminent default. So C means they're about to default. They haven't defaulted yet, and then you've got into the, the defaults, right? So, and here, interestingly, if it's in default, then they're saying that your repayments are going to be through recovery of the assets in default. And double D indicates recovery 50 to 90%, single D is recovery below 50%. So that's your ratings, right? And in terms of ratings, they are quite important, as we saw. Within the standardized approach, you look at the ratings. Internally, they're used as well. Now, the issue is that the ratings are paid for by the person that wants the rating. And that creates a massive conflict of interest. So the person that asks for ratings wants the highest rating possible. The companies that provide ratings, on one hand, want to get the business and want to satisfy their client. On the other hand, they need to be objective. If they're not objective, then nobody will use the rating. Nobody will trust the rating. Internal ratings, so banks do need to develop an internal ratings program as well. And you also need internal ratings for smaller, for unrated companies. Now, where you've got the conflict, in US, this was really important. Right? So in US, people really went rating shopping actively. So often, what they would do is they would firstly get an indicative rating, which is to say, hey, if I was to issue bonds, what rating would you assign to those bonds? Just indicate to me. So then I could go, imagine that there are 3 rating agencies. So I could go to the 3 rating agencies and say, hey, if I was to issue a bond, what would you tell me? What would you tell me? And what would you tell me? And now imagine that 2 of you would tell me triple B, A minus. Which one will I go for? I'll go for A minus. Now, I'll go for A minus even if it costs a little bit more. Because even though I pay a little bit more, my interest repayment is going to be less. On the other hand, if everyone says, yep, triple B, then I'll say, by the way, how much do you want to charge for it? 50,000, 60,000, 60,000. Okay? By the way, I'm only prepared to pay 50,000. And if you don't like it, I'll go to someone else. Right? So all of a sudden, the rating is supposed to be an independent assessment by an expert, but the person who's asking for the rating has all the power. But in the US, they were using it quite a lot. And as I said, imagine that in choosing the subjects, you could go to 3 lectures and say, hey, here's my academic transcript. What mark do you think I would get in your subject? And then say, well, actually, I'm not happy with your answers. I'm not going to take your subject. I'll take another subject. Right? That's, as funny as that sounds, right? That's an equivalent. Right? I don't know what market will get. Depends on what you do. Similar, I don't know what rating your transaction should get. Show me a full transaction, and then I'll give you the answer. Right? What you pay for it. So in terms of calculating the probability of default, this has been at the forefront of banks, right? How to solve this problem. And historically, a number of models have been developed. So you would have heard about the discriminant model. Right? Has anyone heard of this Altman Z-score? You've covered this before, right? Yeah. So Altman Z-score is a wonderful model, right? So what Altman did is he got access to data at the time when not many people used data analytics, and he did. So he had a computer, and he had access to a database. And the database was accounting data in US, which, by the way, in Australia probably still doesn't exist. Right? But in the US, there's a lot of filing of data in a standardized format of standardized ratios, and they had these huge databases. And the idea for the Altman Z-score is to figure out, based on these different accounting data, can I figure out which companies are more likely to default, which companies are less likely to default? And he came up with these figures. He came up with these variables by running standard regression analysis. And he said, well, here are the 5 factors. Working capital on total assets, retained earnings on total assets, EBIT on total assets, market value divided by book value, and sales on total assets. And by running historical data, he came up with the factors as well. And then he said, well, if you take this model and you have these 5 factors for a new company or the company that wants to borrow money from you, put the numbers in and you get a Z-score. If Z-score is above 3, high quality company, unlikely to default. If it's below 1.8, it's more likely to default. And if it's in between, it's a gray zone. Now, a couple of things. One is that no one in Australia uses this model. Because this model is for medium-sized manufacturing firms in the US in the late 1970s. Right? So we don't have that many manufacturing firms in Australia. They might have different balance sheets. The accounting standards have changed dramatically. So we're not actually using this model. But the concept of a model is absolutely sound. And in relation to these types of firms, Altman's model was actually quite good. Its predictive power was about 75% or thereabouts. And they tried to improve this model significantly. And they would make it a lot more complex, different factors, different econometric approaches. And they got it up to maybe like 81% by making it extremely more, significantly more complex. So the model itself, for what it was about, was pretty good. The problem was that it was limited to the types of companies based on which the data and the model was developed initially. Now, it is a discriminant model. Discriminant means it tries to discriminate. More likely to default, less likely to default. Doesn't actually give you an actual probability of default. Right? What are some of your alternative approaches? You can use historical data, right? So of these types of companies, how often have they defaulted? You can use credit spreads, so looking at the market data, or you can use the Mertens model. So historical data, and this is where, you say credit rating, you read what credit ratings are about, doesn't say that it's actually a probability of default. But then, that's exactly what it's used for. So this is the actual Moody's data going back to 1970. So 1970 to 2016. And what it says is, if you look at AAA rated companies, within 1 year, none of them default. Within 2 years, actually some have default. Within 10 years, 0.4% of AAA companies default. So that means if you invested or if you lend to 1,000 AAA rated companies, you would expect in 10 years' time 4 of those companies to default. But if you lend to, let's say, 1,000 single A rated companies, you would expect 22 of them to default. And if you lend to 1,000 double B rated companies, then 162 of them would default. And for triple C, now that actually I found quite interesting. For anything in the C grade, and remember C was very likely to default. After 10 years, half of them were still alive. It's only half of them that defaulted. So you can run your chances. But within the first year, for a triple C company, or for any of the C rated, within the first year, 11% default. It's interesting that 11% within the first year, but overall, 50%. It kind of makes sense that a lot of them would default straight away, and if they haven't defaulted, chances are they might get upgraded. So that's kind of using historical data. Using credit default swaps. We covered a little bit about credit default swaps, I think, in last week. Right? I may have mentioned. Credit default swap is just like insurance. Right? So, if the price is 400 basis points, so if the price of a credit default swap is 400 basis points, then what it means is, if I want to buy, if I'm lending you 100 million, and I'm not sure about your credit quality, so I want to go to another bank and say, hey, can you give me protection against that company? You say, yep, the price is 400 basis points. I go, okay. So for each year that I get protection for 100 million, I pay you 4 million. Okay. So this is the price purely of credit risk. So I will need to charge you interest rate such that it covers my exposure, right, and gives me sufficient return. So this is the credit default swaps in Australia. And we talk about what was happening in Australia and the risk management in Australia. So credit default swap is the price of credit risk. Look at what happened before GFC. And before GFC is basically this. So look at the price of credit risk for a major bank. That's the bottom line. It was basically non-existent. So the markets were not pricing that credit risk at all. This is where we talk about the blindness of the markets to risk. And if you look at kind of what happened, so 2007, August, September 2007, GFC starts, and you can see the CDS rates starting to come off, and then bang, 2008, at the very top of GFC, the rates for triple B corporates are above 500 basis points. So 5% if you want to insure triple B corporate. Single A rate corporates, 350. So you saw BHPs, Rios, Telstras, you'd be paying 3.5% to get any protection. Now, if you think about at that time, right, the interest rates were quite low. The interest rate was, say, 2%, but all of a sudden the credit risk premium is at least 3.5%. And you can see that before GFC, there was a massive distinction between the three. Post GFC, the three lines actually collapsed. So whether it's a single A rated corporate, triple B rated corporate, or a major bank, the pricing was all the same. Another way of getting data is through bond prices. So this is where, CDS is just a standalone instrument, but they're not very widely available. The other way to get this probability of default is to say, all right, well, let me look at 1-year corporate bond versus 1-year government bond. What is the difference in price? What would you say? Part of it is credit risk, but that's just part of it. And this is why this approach is just an approximation. Right? It's not just credit risk. Which one would you prefer? If I compensated you for credit risk, which one would you prefer? A government bond or a corporate bond?
In most cases, government bond.
Why? So not credit risk, because credit risk I'll compensate for. But why government bond? I agree with the answer, but why? High liquidity in the market, correct. What else? It is easier to sell, definitely. You can also use it as collateral. Right? Government bonds, you can use it as collateral with the Reserve Bank. Government bonds, as you'll see, qualifies as high quality liquid assets. There's a whole range of reasons why government bonds are still better. But the main difference in price is likely to be credit risk. So if you know that the government bond is trading at 3.5%, the corporate bond is trading at 4.5%, you can solve it by figuring out that the probability of default is about 0.96%. Right? In reality, it's going to be a little bit less because of other factors, but that's what it is. The other way to work out the probability of default is to look at option-based methods. And in terms of the options-based methods, this is where, think about it again from the point of view of the balance sheet. So when we have a balance sheet, so let's say we've got 195, 5, right? So this is equity. Well, in a sense, the value of the, the value of the equity, that's like the option price. And the value of the debt, that's like an exercise price. Because if you think about it, by paying all your debts, you get the right to claim the assets. If the value of the assets, you remember your basic option pricing. So think about it as a call option. This is the exercise price, right, and this is the stock price. So the exercise price is the value of the debt, the stock price is the value of the assets. If the value of the assets is less than the exercise price, you're not going to exercise the option, and you'll lose the entire value. Right? So if the value of the assets falls to, say, 94, why would the company will default. So you're not going to exercise, the value of equity will then go to 0. But if the value of the assets goes up, then you do exercise the option by paying the debts, and then you can get to claim the value. That's the idea behind the Merton model. And Moody's have bought this system called KMV. Right? The whole idea is that you're trying to figure out what will the value of the equity be, and that does depend on the size of the assets and the volatility of the assets as well. Again, we're not going to have to do these calculations. I just wanted to show this to you. But ultimately, right, you are using the option pricing approach to work out the volatility of the assets. Why is that important? Well, why is the volatility of the assets important? Because, again, if we look at what the value of the assets might be, the value of the assets, we expect the value of the assets to be here. That's the current value. If it's not very volatile, it will condense. If it's very volatile, it will be way out. Let's compare the value of the assets versus the amount of debt. Right? So let's say this is our actual debt level. If the value of the assets is below the level of debt, what happens? Default. This is still about trying to calculate the probability of default. So we're trying to figure out, can we find the distribution of the assets of the firm? And from there, calculate this probability of default. This area, this shaded area, represents the probability of default. And basically, the whole idea of the model is to say, well, we don't know actually the distribution of the assets. We don't know the volatility of the assets. What we do know is the volatility of the share price, of the shares. And the model basically converts the volatility of the shares into the volatility of the assets. So for a listed company, you can use this model by observing the volatility of the shares. You therefore work out what does it mean for the volatility of the assets, compare it to the debt level, that gives you your probability of default. That's the KMV, that's the Moody's KMV approach. So we've covered different ways to working out probability of default. And that's the probability of default is the main number that you're trying to calculate. Right. Credit risk in trading. Final topic for today. We might actually finish just before 9 o'clock as well. So, when we have trading, what is our credit risk going to be? So if we lend someone money, they don't pay us back, there's credit risk. If we write an OTC option to a client, so if I write an option to you, do I have credit risk? If I give you an option, do I have credit risk? Why not?
Option is not
to exercise option?
I'm giving you the option. So I'm selling an option to you. Do I have credit risk? What's my credit risk?
I'm exercise.
Okay. What's my credit risk?
Pay the share. You don't pay the share.
Okay, so if I'm giving you the option, if you don't pay, I'm not going to give you the option. That part, we're doing, DVP, what's it, delivery versus pay, right? So I'm giving you the option, you're paying me money, right? I'm getting paid. After I've given you the option, do I have credit risk?
I think you do. Because only it's over the counter, you don't have central premiums.
Correct? Over the counter, no central clearing, correct. So I've sold an option to you for 50,000, and the option is for you to be able to buy NZ shares at $60 from me. Do I have credit risk?
But if the ANZ share price dropped or increased,
Okay. Do I have credit risk?
No.
Why not?
You will face the market risk, credit risk, because whether the
I'm the one who
customer
actually-
Correct. You're the one that has the credit risk. I don't have the credit risk. If I'm writing you the option, right? If I'm writing you the option, I told you guys, every other subject that you have covered before will come into this subject. Now, remember your option. If I sold you the option, it either has to be a short put or a short call. Well, I can sell you both. Right? The exposure, the answer is the same. Right? If I sold you a short call, that's going to be the payoff for me. If I sold you a short put, right? My exposure is going to go down. What's the maximum that I can make? The premium. So if I collected the premium up front, I have no credit risk. You have credit risk, I don't. Right? So writing an option is different to buying an option. If I buy an option, I do have the risk. Because you may not pay back. And if we have an interest rate swap, if we have a swap, over time, there's a possibility that I'm not going to get paid. So there is risk. How do we deal with risk? So this is where, you do the initial margin to cover the fact that there might be an exposure. So for a swap, you'll have the initial margin. And then, when you do the mark-to-market, you'll be meeting that using your variation margin. So margin will generally be required when you are short selling, right? So if I borrowed stock from you and to sell, you need to have protection, so you'll ask me for some collateral. But also, if you are going to trade, so if you have, as a broker, if you've got clients trading. So if you've got clients trading, they're taking on risk, you will require them to have some margin or provide collateral. Now, what's the idea, what's the difference between bilateral clearing and clearing through a central CCP? OTC transactions, before GFC, was not seen to be such a big deal. Right? The idea was the exchange is there for, you remember the basic lecture you got on derivatives. What's the difference between futures and forwards? The standard answer, futures, standardized, traded on exchange, standardized maturity, all the features. Forwards, flexible, bilateral, not traded on exchange. Now, all the exchange traded stuff, fine on exchange, all the other stuff bilateral. So all the banks end up trading with all the other banks. So if I trade with you, our exposure is to each other. So if you have, in this case, 3, 4, 5, 6, 7, 8 institutions, the relationship structure might look like this. And now imagine taking one of the institutions out of the equation. You can see that all of the direct lines are going to be impacted. But now, what if I do an interest rate swap with you, but to hedge the risk, I then do an interest rate future with you, or an interest rate forward. And then I get an option from you to manage the risk from you. And now imagine that you fail, so my initial transaction fails, and we're settling it, but I still have the hedges. So now it's a problem, because this one trade impacts everything else. And that is the Lehman Brothers scenario. And that's why Lehman Brothers was so complex. This is just 8. Imagine if you got 30. And then imagine trying to unpick all of these transactions to reduce it to a manageable number. In US, what they did after Lehman Brothers is they had to come in on the weekend. They had to open up the financial system to the banks on the weekend to try and offset Lehman Brothers transactions between all the other banks. So they were trying to net down, say, all right, well, I've got this option with you. Do I have an offsetting option with someone else? Let me bring those two transactions together and net them down. So let's net down the entire system. So post Lehman Brothers, the regulator said, we don't want that. We want to reduce the number of bilateral links. They're bad. So instead, to the extent possible, any transaction that can be standardized must be standardized, and then you can agree on a transaction, but you will then actually end up clearing the transactions through the central counterparty. And there's a term for that, right? And it's called the futurization of OTC derivatives. Meaning that futures are on exchange, so the futurization of OTC derivatives is moving the OTC derivatives onto exchange. So when that happens, all of your transactions go through one central point. So now my exposure to the other people is no longer there, but what risk have I created? What's the risk in this scenario? What's the risk? What's the risk? Somebody almost answered it.
Market risk.
Market risk is always there. Everything gets cleared through a central counterparty. What's the risk? If the CCP falls, now if the CCP falls, everything falls. If when I started Basel I, the first point was for derivatives. Did you see that there was nothing about futures in the model? Under the Basel I, the idea was anything exchange cleared, anything through a CCP, zero risk weight. But now, everything goes through CCP, and the potential impact of a CCP default is massive. So, the idea is to still force everything to a CCP. And they do it by saying that standard OTC transactions must be cleared through a CCP. So, and then governments define what a standard transaction is. Generally speaking, interest rate swaps have to be cleared through a CCP. And most of the basic currency swaps also have to be cleared through a CCP. And non-standard transactions So anything bilateral gets punished through higher risk weights. So that's kind of a model. So this is just the role of the CCP. And then the final point I wanted to cover is the credit value adjustment. And this is where we kind of covered it a little bit to begin with. So once again, what is credit risk? We started the lecture with that. What is credit risk?
Risk of counterparty default.
Risk of counterparty default, right? So the risk that the counterparty is not going to pay you back. That's correct. So if we have the standard, assets of different type, let's say 500 here, and then we also have 500 in trading assets. And let's say we've got 900 in debts and 100 in equity. Okay. We said that credit risk is the risk of default. And the models estimate the probability of default. We talked about calculating expected losses, unexpected losses, and holding capital for them. But what happens when the value of the trading assets, if there are concerns about, let's look at this. At this point, right, let's say Telstra's rating did not change. It was rated single A, continued to be rated single A. So if we use ratings as a proxy for probability of default, the probability of default did not change. But the perception of credit risk has changed dramatically. So if I had Telstra bonds in my portfolio, right, what do you think would happen to the value of those bonds? What do you think would have happened to the value of those bonds during 2009? It would have fallen. It would have fallen. So, you guys have done accounting. What happens if the value of the assets falls from 500 to 410? Equity has to fall. If that's the balance sheet of the bank, are you happy to continue to invest and trade in this bank? No. But they invested in single A bonds and they continue to hold single A bonds. So here, this is the issue that got flashed during GFC. It wasn't an issue that was well known before. And this is what CVA is about. So CVA is basically to cover credit value adjustments. It's an adjustment to the fair value of derivatives due to the counterparty credit risk.